Hervé Francois here with the DeRosa Group. We're going to get Palmy and Nancy, sisters, on here to the Market Hunter Thursday. How did you come about by choosing Phoenix?
Prior to getting to start in real estate journey, we were in fashion world. And there's a saying in fashion world, one day you're in and the next day you're out. At that time, we were making great income in our fashion business that we didn't realize the importance of passive income via apartment investing. So we were just spending our money or just, doing what regular people do, which is work hard, earn our money, and then we buy liabilities, right? At that time, we didn't realize that important thing, that the reason we were making great income wasn't because we were smart or we're doing something different. It's because we didn't manage to spend all our money yet. Had we known what we know now that about passive income via apartment investing, we would be safe in any circumstances, even if there's global pandemic or even economic downturns. And then that's what our financial freedoms means to us. And that's why we come up with the name Not 9 to 5, because we need to stop grinding from 9 to 5 and have our money start working for us instead of us working for our money. Yeah, so that's why we started a name. Is kind of like our mission statement that we want to bring everybody along with us to our journey so that you guys can have financial freedom like us now that we do.
And live a not 9 to 5 lifestyle as well.
Yes, and then why do we choose Phoenix market? Well, Palm is going to get into it a little bit.
Well, the reason Phoenix has been such an attractive market is it has long-term stability. Population growth has skyrocketed, especially in this year. You can see that job growth has driven net immigration into the submarkets. They have an extremely business-friendly environment. So the government is encouraging new businesses to move their headquarters or moving there. Operationally, it's really nice. There's no rent control. In LA,
why friendly?
Why not LA? LA has massive rent controls, and they keep passing new legislations that make it very difficult for landlords, small landlords, to be able to survive. So those are deterrents. High yields, historically, Phoenix has been a really high yielding market, and this year you can see the yield is 9%. And historically, the 1990s, it's been 6-7% year over year yield. Again, net migration is also a key factor because
more and more people are moving from city like California, like New York.
So would you say a lot of the investors that you come across in Phoenix, are they folks that are from Phoenix, based in Phoenix, or are they investors from outside of Phoenix, such as yourselves?
Yeah, so outside.
Yeah.
In Phoenix, what type of properties do you guys prefer to pursue in regards to what's worked well for you in the past?
So for us, we love to invest in asset class that has a little bit of both. So it's value add, but it also it's yield play as well. So basically what that means is we don't do, unlike single family flips, we don't go for the ugliest, dirtiest property. We seek properties that maybe have been mismanaged. Maybe there's some, the ownership has been there for a long time, so they haven't felt the need to raise rent because they're comfortable and they don't want to stir the pot. So what we do is when we invest, it's 90% occupancy or higher.
So one of the property that we invested in, we took over, it was 100% classic unit. And that's what we love, because we can go in and then renovate and push up the rent cost to the market, because right now it's been under rent. And what we see during the pandemic, we actually been able to do distributions for our investor. We didn't stop. The Phoenix market is on fire, and then we've been doing well. There are some hiccups. We're not going to say everything is rosy, but we're able to manage with our team and able to give the distribution on a quarterly basis to our investor.
The type of properties that I think are best for multifamily investors is B and C. And why B and C is because there's a not when they're building new properties, they're not building B and C.
They can't,
right? Because it's
the replacement cost is also high.
So they're gonna build. They're all mostly are A's. So A properties, they're gonna be concessions, or there's gonna be some battle up there when you're coming with homes. But B and C are workforce housing and transitioning to white collar workers, tech workers in the right community. So therefore, it's a really nice area where you can force appreciation by doing renovation, like Nancy said, while you can buy in at a C price, but hopefully you can bring it up to a B value.
Yeah.
When you do that value add renovation, and it's in the manner that we pursue our opportunities as well over here out on the East Coast, what type of rent bumps do you guys see as a benefit to your business model after you get in there and maybe you replace property managers, you lower your operating expenses, and then take up the bumps? What kind of average increase in rents are you doing once you finish that renovation?
We're looking for about like $100 to $150 in bumps,
Wow. Okay.
depending on, and that's kind of like across the board. That's what we look for. So in this case, we're also doing washer and dryers in the units, so that's another $50 bump. And
Okay.
all this, I mean, when you do these kind of renovation, it's really important to verify what your comps are doing.
Mhm.
So there's no point in like making it like granite countertop high-end appliances when
Right.
the comps are not doing the same thing. It's going to be overkill, and you'll never be able to achieve that rent bump that
Right.
you expect. So you really have to balance it against what other people are doing. Never be the trailblazer. Always verify. Let someone else take the lead. They can take the
Yep.
baton. Fine. We'll come in after you, and we'll see where you come in, and then we'll do what you did.
When you talk about the deals that you've done in Phoenix, number one, how have you found them? Right? I mean, that's a huge question we typically get investors. How do you find your deal? It's so tough to find deals. And then number two, typically, how have you financed those deals in the past?
Multifamily is a team sport, so we leverage our team and then also through our broker relationship to find a deal. We learned from a long time ago about OPM, which is other people's money. So
Yep.
if we go out there and try to look for a deal, we can only probably find like one or two deals that we can fund personally. So what we do right now is leveraging other people's money and then do a apartment syndication.
And then like as far as like specific financing, we use agency debt. So it's Freddie or Fannie. And these are amazing because they're non-recourse.
Yeah.
For large multifamily apartments, of course, we never plan to default or walk away. But if it ever comes to that, it's not connected to a personal guarantee. So that's why it's a really, really nice vehicle. And also on top of that, it's long-term fixed debt. It can be variable, which right now is actually good to do floating. But basically, traditionally, it's 10 to 12-year debt.
Mhm.
So
Right.
we're holding properties for 5 to 7 years. So
Okay.
we want you should try to get debt that exceeds your market plan hold.
Yeah.
So if your business plan is I'm going to hold this for 5 years, you want something longer.
Like 10 years.
Smaller deals, like let's say $1 million or less, commercial loan
Yep.
would be fine. But anything above that, go with Freddie or Fannie.
Like 1 to 6 million Fannie, and then anything above 6 million,
Freddie is a good one.
yeah, Freddie is a good one.
Especially
Yeah.
20 million. Freddie is amazing. They have very good terms right now.
Is there a certain number of units that you guys tend to, stick towards? You do have some universities over there in Phoenix. Do you look into student housing for your investors, or is it predominantly workforce housing?
65 units and up is what we look for. And that's because we want economic efficiency. We want to be able to hire full-time staff on site. We want at least one property manager, a leasing person, and also then a maintenance guy, maybe an assistant. We have someone on site because we want to sign that lease. Maintenance-wise, once we have them on our property, we want to take care of them. We want to make sure that they're happy. We want them to renew. And that means that we have maintenance people who are there to quickly address issues.
Yes,
So that's why 65 units and up is,
economy of scale.
yeah, will be helpful for that.
At what point do you get concerned, unless you've already started getting concerned in regards to the amount of supply coming onto the market? Well, new development from developers out there reading the same tea leaves that you guys are reading, and because of that, they want to now start adding shovels to the ground for new development. Is that a concern of yours? Number one. Number two, from a competitive standpoint, are you beginning to reach the top in regards to, the bidding that may be going on back and forth between the properties over there? What kind of impact it might have on the cap rates? And because of that, you guys need to start looking at other cities for your investments.
Yeah, first of all is that the absorption rate, which is the rate at which apartments that become available are being leased up. Phoenix is top 3 in the country in 2020. In Q3, that's the case. So there are new properties coming online. In fact, there's 15,000 units right now under construction, And year to date, 7,200 have been delivered. And you can see right now, even with the amount of new products coming online, it's being absorbed really, really quickly because the rent growth is extremely high in that market. Right now, multifamily occupancy rate is at 95.6. Phoenix is the top 7th market in the country with occupancy rate. So that part means that new construction isn't a huge concern. But you can see, like, cap rate, I see cap rate as important, but at the same time, it depends. So if the property has been under market, has been held by the same ownership group for a long period of time, like 17, 20 years, maybe we're purchasing at a lower cap rate. But that doesn't mean that it's overpriced. It means that it just means that it is. It's a way of measuring things, but it's not the be all or end all of it. Because, okay, we bought a property for $96,000 per door, right? Last year. So that property, I think the cap rate was like 4.6, something like that. And the reason for that is it's so under market, right? When we bought it. Right now, the average per unit price in Phoenix is like 161,000.
161,000.
Ours, we raised it by $40,000 per unit already right now.
So yeah.
So cap rate is important, but it's not going to be, it can't be the only thing, the only tool you use. You have to look more overall picture of the asset class. As far as bidding, like, everyone is looking at the same market. Retail, commercial, like other commercial assets, retail, warehouse, office, hospitality have all been tremendously affected by COVID, not apartments.
Right.
So everyone's pouring more and more money into multifamily. So that means that, yes, it's become really competitive, but I would assume that people who did this 30 years ago would probably say the same thing. So you have to be in it to win it. So since 2008, in real estate, they're like, oh my God, there's gonna be a new bubble.
So they've been waiting, holding, and boom, 2020, right?
So had they been on this ride, 7% yield per year, they would have been crushing it. But you have to buy at the right price. You have to understand what you're doing.
And having the right team who can, you can leverage and then also grow with them.
Yeah, like Nan was asking me earlier this morning, like, think about it. Do you think that home prices are going to be more expensive 30 years from now? Or is it going to be cheaper?
Right.
Yeah, would you think like healthcare, college education, would it increase or not increase, right? And that kind of go back to what the government is doing, which is quantitative easing. They're printing out money, and that's what we're seeing, the rise in the inflation. And then
so the money supply, we have a lot more money in the system right now. We have other people looking to the business. So yeah, it's competitive, but if you know what you're doing and you're in it for the long term, we're not looking to buy hundreds of properties. We're looking to buy a couple
in a year.
So therefore,
got you.
Having the right team, you have to do that.
Nancy, this is Chris and Maricela. I guess they met you on the 12th. So they want to ask, like you had mentioned, that you look to increase your rents by about $100 to $150. Overall, what percentage is that in Phoenix relative to what they've been seeing in Austin, Texas? Because there's been an explosion in real estate growth values down there. They've been able to increase over 33% over the past couple of years. So that $100 to $150 rent bump in Phoenix, what percent increase is that for you guys?
If you take let's say our rent was like 900, 950
or 700, right? The
so
slower one,
whatever that percentage is. Yeah.
So okay, let's say it's 700, 150 to 700.
Yeah.
We're like, oh. How they calculate?
That's cute. Yeah, the numbers are the numbers, no matter what the calculator looks like.
20%. So why are you doing?
Okay.
One thing, you don't have to be a math genius to invest in an apartment.
You use a calculator.
We have a technology.
We all got calculators, the Google Sheets, all of that. No, right.
We invest in Austin. Yeah. We love Austin. The only thing is cash flow producing versus we are passive investor in a deal in Austin. It's been doing great. It's just there's no cash flow. So
there's no cash flow. So it's mainly, so the majority of that IRR is going to take place once they sell the property, right? Yeah, and that's where you get the majority of returns.
2.5% annually, not even like monthly.
Oh, wow.
So,
but they did refinance it.
But we still love it.
Yeah.
Because, you always want to do like a cash flow play, and you want to do a yield play. So you want to do both.
So yeah,
either or, but we want to do both for like immediately to help, finance our expenses to live the not 9 to 5 life, and also to,
You want like the 1.72x at the end. So
as well.
I mean, for us, like if you hold it 3 to 5 years and that's something that it can be achieved, I think that's amazing.
Yeah.
Population of 1.7 million, there's got to be some nice areas to invest within Phoenix and maybe not so nice areas to invest in Phoenix. So where do you guys kind of plant your flag as to these are the areas within Phoenix that you're going to focus on your multifamily?
Question, and I think it's most people don't ask that. So your audience who are really, they're very sharp to really to consider that point. So what we found is along Interstate 17, Northwest Phoenix has had the highest rent growth, is the strongest in the market. The rent growth is around 8% in the past year. So the Metro Center and the surrounding area is what you look for. Also close to ASU, which is basically the Silicon Desert area. That's a nice market because you're going to be able to catch people who are, maybe you have a workforce housing apartment, but you're transitioning to more tech people.
Mm-hmm.
That's going to be a good thing because what you want is inevitably you want to be able to bump rent up, and you want to find an area where people who are moving to that area can afford higher rent. So if you're renting to a landscaper, he may not be able to afford your 100, 200, 300.
Who works at a tech company.
Yeah, compared to a tech. So those kind of thing, yeah. But like along Interstate 17 is in Northwest Phoenix is the hot market. Yeah.
Okay. All right. That's good to know. All right. Northwest Phoenix it is. I need you, the experts of Phoenix, to put an itinerary together for me. What am I doing there over a 3 to 4 day stay?
The leisure side, Saddleback Mountain, definitely go hike there. There's many different trails. Go early. Don't bring lots of water because,
And then it's just 2 hours drive and it's worth the drive.
Yeah.
It's beautiful scenery and also many rock formation, which is like awesome.
So
beautiful to see the sunset at Cathedral Trail and then go hiking on the Devil's Bridge.
This has been great. This is awesome. I can't thank you enough. Palmy, Nancy, Kitty from Los Angeles by way of Phoenix, Arizona, or vice versa, however that goes. We learned a lot about it. 5th largest city, very fast growing. Silicon Valley, tech companies, healthcare companies, education, cash flow, C-type properties, 65 units or above that you guys look for specifically, and particularly target your shopping in that Northwest area by Interstate 17. Enjoy and have a great weekend.